Hello, and welcome to Investors Psychology. Today, we're diving into a question every long-term investor asks: gold versus silver versus Nifty 50, which has really delivered over the past 2 decades. We'll break down the numbers, the why behind the moves, and what it means for you. Let's get started. First, the players. The Nifty 50 is India's flagship large-cap equity index, a proxy for investing in Indian corporate India. Gold, the timeless safe haven and inflation hedge. Silver, a less celebrated but dual-role metal, both precious and industrial. First, the players. The Nifty 50 is India's flagship large-cap equity index, a proxy for investing in Indian corporate India. Gold, the timeless safe haven and inflation hedge. Silver, a less celebrated but dual-role metal, both precious and industrial. When we talk 20-year returns, we're looking at roughly the period from 2005 to 2025, or in some data since 2000. While exact annualized figures vary by source, the broad trend is consistent. Equities, gold and silver each have their story. For instance, over a 20-year horizon, the Nifty 50 TRI delivered around 14.6% CAGR, turning 1 lakh rupees into 15.2 lakh rupees. Silver and gold. Gold turned 1 lakh rupees into 15.5 lakh rupees, approx 14.7% in the same span. But the caveat: silver's long-term 20-year number is less frequently quoted, and shorter horizons show sharper swings. Let's look more closely at the data. Then we'll discuss what it means. Equities, Nifty 50. According to a June 2025 report, over 20 years the Nifty 50 TRI gave 14.6% annual return and multiplied wealth by 15.2 times. That means 1 lakh rupees invested 20 years ago would be 15.2 lakh rupees now, excluding taxes, fees. Gold, same period, 14.7% CAGR and 15.5 times wealth multiple. Another study: since 2000, an investment of 1 lakh rupees in Nifty would be 16 lakh rupees today, and same in gold, 22 lakh rupees. That data suggests gold slightly ahead, but again depends on exact start-end dates. Silver. While exact 20-year numbers for silver are less frequently publicized, data from 24-year span, from 2000 to 2024, shows silver and gold have underled in many years versus equities. For example, in 24 years, the Nifty led in 12 of them, gold in 7, silver in 5. In more recent years, silver has caught up strong due to industrial demand. For example, in 2024, silver and gold both outperformed equities. Key takeaway on numbers: equities have delivered solid long-term returns, 14 to 15% CAGR in India. Gold has kept pace or slightly better depending on timing. Silver has higher variability, sometimes huge gains, sometimes weaker years, so long-term average may lag, or just slightly behind equities. Now, numbers are one thing, but behavior of these assets is another. Understanding when they perform helps with allocating smartly. Safe haven versus growth: gold tends to shine when equity markets struggle, when inflation is high, interest rates uncertain, or global risk is elevated. For instance, in the 2008 global financial crisis, the Nifty fell 50% plus, while gold rose 30%. Silver, though similar to gold in safe haven role, has the added twist of industrial demand, electronics, solar. So in growth phases, it may lag or lead depending on cycle. Equities are growth assets. When the economy, corporate earnings, and risk appetite are high, equities outperform. Volatility and drawdowns. Equities, higher average returns but bigger drawdowns. Gold, more stable returns in bad times, less drawdown. Silver, highest volatility among the three, meaning higher upside, but also higher risk. Time horizon matters. Over very long periods, 20 YRS plus, equities tend to win slightly, because growth compounds. Data shows that over many rolling 3-year periods, the Nifty led in 56% of the time, while gold-silver led in 21–23%. But if you pick the wrong time window in equities, e.g., entering near a peak, you could have a decade of poor returns. Metals can act as a hedge. Correlation and portfolio role studies show that gold has a negative short-term correlation with equities, i.e., when equities fall, gold often rises. Silver's correlation is more complex because industrial demand ties it somewhat to growth. So from a portfolio lens, equities for growth, gold for protection, silver for a speculative industrial metal tilt. Okay, so you know the numbers and behavior. What do you, as an investor, especially long-term in India, take away? Key lessons. Start early and stay invested. The magic of compounding works best when you stay invested across cycles. Time horizon matters. If you have 15-20 years or more, equities have strong case to be core of portfolio. Don't put all eggs in one basket. Gold, and maybe silver, play important roles as hedges or diversifiers. Know your risk profile. If you can take volatility and want growth, lean equities. If you want safety, gold. If you like high risk return, allocation to silver maybe. Asset allocation beats timing. Trying to time which will outperform is risky. A mix improves outcomes. Beware of valuations and cycles. Just because an asset has outperformed recently doesn't guarantee it will continue. For example, metals had big runs. Equities may face headwinds at times too. For someone in India, consider a core portfolio of equities via broad index, e.g., Nifty 50 or large-cap mutual funds. Keep a portion in gold for protection, especially as inflation hedge. Silver can be a small tactical tilt since it's more volatile and less proven over long period. Rebalance periodically. After big moves, lock some profits or shift back to target weights. Let's tackle some frequently asked questions and myths. Q1. Gold always beats stocks. Myth. Over long term in India, equities have often matched or slightly beaten gold depending on timing. But in many shorter periods, gold has outperformed. It depends on start-end. The data from 2020-2025 shows gold 22 lakh rupees versus equities 16 lakh rupees for 1 lakh rupees started in 2000 in one dataset. Q2. Silver is the secret weapon. Part true. Silver can deliver big gains, especially when industrial demand surges. But with that comes higher risk and less predictability, so it isn't the sure win relative to equities. Q3. Equities are too risky. Yes, they are more volatile, but if you have a long horizon and stay invested through cycles, they historically deliver. The catch: you must stay invested and avoid giving up when markets fall. Q4. Metals are pointless if they give same as equities. No, their value is in diversification and risk-adjusted returns, not just raw numbers. Having some metals can reduce downside risk in bad years. So here's the bottom line for you. Over 20 years in India, equities, Nifty 50, 14-15% CAGR, gold, 14-15% CAGR. Silver's variable, but in many periods, lagged equities. Equities win for long-term wealth creation. Gold wins for protection. Silver is an optional booster with higher risk. A balanced portfolio, rather than chasing the best asset, is likely the smartest path. If you found this breakdown helpful, keep watching for more insights on how to build your wealth and understand your investor's psychology. I'll see you in the next video.